In this video, I'm going to show you exactly how I made over $3,000 trading NASDAQ today using my IPD FEG model. Right here, as you can see on GOAT Funded Futures, you can see I made $1,248, the only trade that I've taken this week. And then if I go over to my Top Step account, as you can see, it's the first of the month and no other trades taken this month, obviously. And right here, you can see I made $424 times 5 accounts because I took it on my leader account and I have an extra 4 accounts, equaling over $3,000 on the day. I'm going to go ahead and pull up my TradingView chart so we can get directly into, there we go, directly into what I saw on the day, what trade I took, my morning bias, how I went with that, and exactly how I took and spotted this setup. So I'm going to take all of this nonsense off of the chart right now and go into what I saw, starting off with my morning analysis for the morning. So as you can see, this is the current weekly candle that is open right now. What do we know and what do we need to look for on the weekly and the daily time frame? We need to look for, are we drawing to or away a PD array, or are we drawing to or away from liquidity? And as we can see right here, we have a PD array right here, which is going to be our weekly fair value gap right there. And then we need to find some type of external range liquidity, which is going to be these two relative equal highs, which is also all-time highs. So what can we see here? We came down with a somewhat of an internal range liquidity move, taking out or entering inside of this weekly fair value gap, coming out of it and heading up towards all-time highs. So coming into the morning, that made my bias a little more bullish. Obviously, you have to drop down into the smaller time frames to actually see and determine your bias. But dropping down to the daily time frame, now all I had marked out on the daily time frame was previous day high, previous day low, and then previous day consequent encroachment. Why did I have previous day consequent encroachment? It's important to have previous day consequent encroachment because this is where high probability setups form. It forms around previous day consequent encroachment, so price can go towards previous day high or previous day low. That's all I really had marked out on the daily. Now, dropping down into the 4-hour time frame. On the 4-hour time frame, I noticed that we had this 4-hour fair value gap, which market opened somewhere around here. It'll be more obvious once I drop down into the smaller time frame. But we had previous day consequent encroachment, which is this line right here. And then we had this 4-hour bullish fair value gap. So just keep that in mind. There was nothing on the 1 hour that I noticed. And then I'm going to go in and go to market open. And market open is going to be this green line that you see right here. So now that we are inside of the 15-minute time frame, what am I going to mark out? I'm going to mark out this 15-minute fair value gap. Why am I going to mark out this 15-minute fair value gap? It's because for the manipulation moves, you want, or the Judas swings also, you want the Judas or the manipulation to come down into some type of fair value gap, as you will see once I drop down in the smaller time frame. So it's always safer to have other fair value gaps marked out as well, because as you can see on the it looked like we completely ran through the 4-hour fair value gap, but as you can see on this candle, we came down and closed right back above it, so we were kind of respecting that 4-hour fair value gap at that time. We also had taken out London low, which I'll show you just with the indicator. Let's take it off. Anyways, it's not going to show up. So this was London low. We already took out Asia low. And I noticed that we had kind of a accumulation and a manipulation move down on the 15-minute. 5-minute, nothing important really. The only thing that you really need to mark out on the 15-minute time frame are these 5-minute fair value gaps. Since we were bullish on the day, these are the fair value gaps that I need to look to get taken. So dropping down to the 1 minute time frame, let me go back to market open, and then I'm going to get rid of this 4-hour candle. I'm going to keep this 15-minute fair value gap here, and these two gray ones are going to be our 5 minutes possible inversion fair value gaps. And what do we notice happening before markets even open? Before market even opened, we had this massive accumulation range, right? So we'll make this green and I'll label it accumulation, top center. So we accumulated, right? And then market opens. What do we look for during market open? We are looking for a liquidity sweep, also known as a Judas swing, which is faking out traders. What do we see right here? This whole entire move is taking out retail traders, right? There's two things that's happening. It's taking out traders that bought around here, right? And all of their stop losses are now below these lows. So it's taking them out. And it's also setting up the stage for breakout traders for when they enter their shorts to get taken out when the market actually distributes back to the upside. So we have our accumulation, we have our manipulation move down into a 15-minute fair value gap. And then what else do we see? We have the first presented fair value gap right here. Put this inside, right? First presented fair value gap. Then other things you need to mark out in the morning is going to be your regular trading hours. And as you can see that this gap was way too large to fill. Whenever a gap is over 120 points, as you can see right here, it's 266. It is not likely to fill entirely. As you saw, market did not fill that gap entirely, but it did come back up inside of it. So, gonna get rid of this fair value gap. Now, coming into the morning, since we had red folder news, we had PMI at 10 a.m., right? As you can see, 10 a.m. right here. What does that mean for the IPD FEG model? Before, whenever there's no red folder news dropping at 10 a.m., you trade the IPD FEG model only entering between 9:50 and 10:10 macro time, okay? Now, when there is news at 10 a.m., then that means you could trade 5 minutes earlier, so 9:45. You stop looking at 9:55, wait for news to drop, and if your setup still hasn't formed, then you can trade from 10 a.m. to 10:10 after that news is dropped. So now, our macro time, if I get rid of this magnet right here. So essentially, if I make this black, I'll mark out the macro time so it's easier to see for you. This is going to be our new macro time, trading up until 55 for our entry, right? So we got a no trade zone right here. You're not allowed to enter in between these 5 minutes. Why? Because it's 5 minutes before PMI, a red folder news that is dropping at 10 a.m. And then you can trade after these 10 minutes if the setup hasn't formed. But what do we see happen? Well, we have our market structure shift right here, along with a fair value gap. Make this gray middle line. We'll make it green. And then we'll get rid of all this just because it's in the way. But we'll keep that macro time. We have our fair value gap going above this market structure shift high along with a market structure shift. Okay. What else do we see? We have that 5 minute inverse fair value gap along with an inversion of the first presented fair value gap, right? As you can see, we came back above, came down, wick down, and then came up, creating that market structure shift. That is instantly telling us that we are allowed to enter the market, put our stop loss at this recent low, and then what are we looking for? We're looking for relative equal highs, right? So if we go here, smooth edges, we have this high, bam. We have this swing high and this swing high right here that are relative equal highs, and that is going to be what we are targeting. So you remember, you need a low variance. What does a low variance mean? If you actually want to learn the low variance, I'm going to have a YouTube video up on how to rinse prop firms, and it's going to talk about the difference between high variance and low variance and exactly why it's important to have a low risk to reward in order to actually be able to rinse prop firms. So having a lower risk to reward, as you can see, this is a 2.1, so a 1 to 2 RR. Entering inside of this fair value gap, I took one position as soon as this candle closed, and then my second position building me more size the second that we entered inside of this fair value gap. And as you can see, this fair value gap is also an institutional entry flow order drill. Why? Because we wicked down and the price went straight up. One of the strongest confluences right here using the IPD FEG model. And then from there, I was just looking for a smaller target because I knew it's the day before NFP. We have NFP news tomorrow. So usually it's a lower range day and it's going to be more choppy and it's not going to run to a previous day high or previous day low, which we would usually be targeting. So this is why you choose the accumulation highs and its relative equal highs as a stronger confluence. And then as you can see, once we got up here, we stayed up and in between this 5-minute inversion fair value gap that we marked out before. And as you can see, this 0.5 is around where previous day consequent encroachment was and what made this trade so much stronger. So this is the exact trade I took today to make over $3,000. So if you want to learn more, go ahead and click the link in the bio and see if you qualify for the one-on-one mentorship where I guarantee you profitability and 6 figures funded.